Bank boards and executive teams should know that the current M&A environment is similar to what we saw in 2016 and 2017 from a deal count perspective. However, overall deal value has increased significantly, which has really been driven by a handful of transactions over the billion-dollar threshold that we didn't see in 16 and 17. In addition, macroeconomic environment is ripe for M&A activity, especially in the regional banking space. And that's really driven by four main items. One is when you have tax rates, corporate tax rates have decreased, which is driving additional earnings, giving excess capital for folks to do acquisitions. On the regulatory front, there's been some easing both to capital standards and other cost measures that could potentially drive M&A. You have increased interest rates are driving yields on investable assets, giving more earnings power to banks to drive M&A, as well as there's increased demand for deposits, especially when you look at the trends in deposit betas that are really driving M&A activity as people try to get funding sources. Bank valuations are rising, but I would not expect a significant change in deal structures when you're looking at a whole bank acquisition. However, if one is looking at buying a non-traditional bank, such as a fee-based business or a fintech capability play, then yes, we would expect differences in deal structure. And in those acquisitions, they often have more value once they're on a bank's platform. And given such, it's very hard to value those companies on the front end. So therefore, we are seeing alternative structures, whether that's structured with a significant earnout, or it's a step acquisition that allows banks to acquire additional equity as performance measures are met, over a longer period of time. I would think the banking industry can expect 2019 to be very similar to 2018 from a deal count perspective, as well as a slight increase in deal value, which is consistent with 2018. I think what the real primary driver of that will be if both regional and community banks decide they can give more value to shareholders by being a seller versus a buyer. That will then provide additional targets for the super regionals that are no longer constrained by the $50 billion SIFI designation. Given the current credit cycle, banks should understand that most targets have grown their asset base tremendously over the last few years through organic and inorganic growth. But the question remains, have they grown to the detriment of underwriting standards? Given that many companies are projecting or scenario planning for a downturn in 2020 or beyond, companies should stress test any target portfolios under those standards to see what it would look like. Banks that are evaluating their overall growth and M&A strategies first need to define what success is. And when I think of success, it is what is the reasonable scale we want to get to as an organization? What is our optimal asset funding mix? And what does our overall operational efficiency need to be? Any of those that can't be solved organically need to be targeted in very specific way from an M&A perspective. That includes a target screening process whereby you can avoid an auction process and really identify what entities will be accretive to that overall strategy.